A 500 credit score means a 12% interest rate on a car loan, costing you an extra $12,000 in interest. At a 750 score, that rate drops to 3.5%, allowing you to keep that money for your own savings. To bridge this gap, you need a 4-step framework that targets the specific mechanics of your credit report. This process takes 12 months, requires no money, and bypasses paid repair services entirely. Later, I'll show you the specific letters you can send to remove late payments from your history. But first, we start with an immediate action you can take to see movement on your score this week. Most people believe credit repair takes years, but certain tactics can trigger a score increase in as little as 48 hours. The first is the authorized user strategy. By having a family member with a perfect payment history add you to their oldest account, their years of on-time payments begin reflecting on your own profile. If you don't have an account to piggyback on, you can link your existing utility and phone bills to your credit report through a data verification platform to achieve a similar effect. This single step typically produces a jump of 20 to 40 points within 2 days. While these quick adjustments provide initial momentum, moving toward a 750 requires optimizing the 2 largest categories in the FICO model. This chart shows how your score is calculated. The most significant portion is payment history, which accounts for 35% of the total. This is where past missed payments or collections reside, and they act as a heavy weight, dragging down the rest of your profile. For a single isolated missed payment, you can send a goodwill deletion letter. This is a formal request for the creditor to remove the mark based on your overall history of reliability. More severe marks, like accounts and collections, require a different approach. You should never pay these off until you have a specific agreement in place. Use a pay-for-delete letter to negotiate. You agree to pay a portion of the debt only if the agency provides a written guarantee to remove the account from your credit report entirely. These written requests allow you to address specific negative entries rather than waiting 7 years for them to age off your report. The second most influential category is credit utilization, making up 30% of your score. Because this is based on current balances, it's the fastest lever you can pull. Utilization measures how much of your limit you use. If you have a $1,000 limit and spend $900, banks assume you are overextended and your score drops. To maximize this category, your reported balance needs to stay under 10% of your total limit. Success here depends on understanding 2 different dates on your billing cycle, the due date and the statement closing date. The due date is simply when you must pay the minimum to avoid a late fee. The statement closing date occurs several days earlier. This is the moment the bank snapshots your balance and reports it to the credit bureaus. If you pay your card down to a 1% balance just 48 hours before this closing date, that is the number that gets reported for the month. This timing shift ensures the bureaus see a low utilization rate, triggering a significant score increase next month without changing your total spending. With your score rising, you have to avoid the most common mistakes that can reverse your progress overnight. Never close old credit accounts. The algorithm rewards the average age of your accounts, and closing an old card can significantly shorten that history. You should also avoid applying for retail store cards. These often come with low limits that hurt your utilization and cause hard inquiries that lower your score. By following these 4 steps, you can move from subprime to prime credit in 12 months, saving tens of thousands in interest over your lifetime. Treat your credit as a financial tool.